Good morning. Mike Van Dusen, Woodrow Wilson Center. I want to welcome all of you. You got bios of all of our speakers. This is the first of a series of 2 programs. We thank you for being here. The next one will be at the same time next Friday, February 4th. You have the bios of my distinguished colleagues, and I think we'll start right away. Kent Hughes will be the first. This general theme today will be the global economy, talking about various aspects, some urban issues, some migration issues, but I wanted to start by thanking you for being here. I just want to say the Woodrow Wilson Center is a public-private institution, and it serves as the official national memorial to our 28th president. Kent Hughes, you're up.
Thank you, Mike, and thank you for coming this morning. Thank you all for joining us on what once again is a snowy morning. We had some flakes coming down as we arrived here at the Rayburn building. Well, as Mike said, our focus here is on the global economy. And in fact, it's almost impossible to draw the old convenient lines between what's domestic and what's international. That the reality of globalization has really extended to virtually every small town in the country. And I'd like to just focus on 2 aspects of the global economy and how those issues might confront the 112th Congress. First, let me take a look at international trade. And again, the context has changed so much over the past decades. It's grown more rapidly than the world economy itself. We trade now parts, not just products. Often you open up a personal computer and it will look like an electronic version of the United Nations. Part here, assembled there, added another part, and so forth and so on. Technology has changed. The reality of trade, communications, containerization has facilitated all kinds of trade that might not have been possible 15 or 20 years ago. Well, what's this going to mean for the 112th Congress? Well, first, I think you're likely to see the President propose action on all 3 pending free trade agreements that have been negotiated by the United States but not yet submitted to the Congress. It looks like there will almost surely, I think, the Korea Free Trade Agreement will come first. And a lot of negotiations subsequent to the initial agreement, but you now have an agreement that is not only supported by the importing community, but also by Ford Motor and the UAW, the United Auto Workers. There are certainly voices in the Congress that are saying, let's do all 3 trade agreements at the same time. Colombia, the free trade agreement with Colombia has raised questions because in the past there has been a pattern of assassination of labor leaders, and organized labor in the U.S., strong supporters generally of the Democratic Party, have been particularly concerned. Sandy Levin, the ranking member on Ways and Means, and now Senator Baucus, the chair of finance, will have, Sandy Levin has, and Senator Baucus will, visit Colombia. Recently, a tax treaty was signed between the United States and Panama, ratified by the Panamanian legislature, so there really are no issues outstanding of any major nature with regard to Panama. So that's number 1 coming up. 2, hovering in the background are the multilateral negotiations, better known as the Doha round of development negotiations. They have been going on since late 2001, so they're coming up on their 10th anniversary. There's a question over agriculture. What kind of changes will Europe and the U.S. make or be willing to make or think about making? And at the same time, there's a concern from the developed world point of view about greater access for manufactured goods to India and to some extent China. The Bush administration launched, and Obama administration has continued work on a trans-Pacific partnership. Currently started by working with a number of countries with which we had free trade agreements. The big question to watch is whether and when Japan decides to join those negotiations. This is something that's not likely to be finalized this year or introduced this year, but no doubt Congress will be asked for their advice and observations as these negotiations proceed. There's going to continue to be concern here about, are we economic relations with both China and India. As you know, there's a constant question of Chinese currency practices. Senator Sandy Levin has already announced that he will reintroduce a bill dealing with Chinese currency. It passed the House by a large measure in the last Congress. It did not come up in the Senate, but that's something, again, that you're likely to hear about, and there are strong interests here, domestic interests, on several sides of this issue. There's also been a recent report from the Economic Policy Institute with regard to high-skilled immigration, the so-called H-1B visas. And high-skilled immigration is likely to be an important component of any congressional debate over immigration reform. Well, let me jump quickly just to international finance and then cede the time to the rest of the panel. Everybody is more than aware of the financial crisis that we've gone through the last 3 years. It really started in 2007. We came close to falling off the proverbial cliff after Lehman Brothers went bankrupt in September of 2008. Well, since that time, there has been a lot of negotiating going on here with regard to the Dodd-Frank bill, but also in Europe and other countries as to what kind of reform of financial regulations should take place. You're likely to see here, I think, in the Congress, moves to modify in different ways the Dodd-Frank bill itself. At the same time, our Treasury Department and the Federal Reserve are engaged in these global discussions about, once countries decide how they want to change their regulations, how does this fit together in terms of a global system. The Basel Committee, which is an organization that includes our Treasury Department and the Federal Reserve and similar institutions from another 20-plus countries, have been looking at what kind of capital standards, how much capital should a bank have. And they've also taken a step to saying whatever that decision finally is, and they've reached an agreement as to what it ought to be, if you're systemically important, and then the question is how you define that, if you're systemically important, you have to have more capital. Well, I'm sure that the large banks here and elsewhere, Europe and Japan, will want to have as much flexibility as possible. So you as congressional aides and members of committees are likely to hear from those institutions about whether we really ought to go along with what those recommended standards. And finally, there is a question on what trading and current account imbalances. Right now, just as we worry about a fiscal deficit, we're running a big international deficit in terms of trade and the slightly broader measure of current activities, the so-called current account. You're likely to see a lot of discussion on that in both sides of the Hill. It's not unrelated to Sandy Levin's interest in doing something about currency. Well, let me stop there, and I'm delighted to take any questions.
Thank you, Kent. Our second speaker is Dr. Sonia Michel, who's the Director of U.S. Studies at the Center. And Sonia is going to, I think, talk as much about the social as well as the economic aspects of global migration. Sonia.
Thank you. Thanks for being here, everybody. I just want to pick up on one of Kent's points, which is that it's hard to disaggregate domestic and foreign policy concerns. And I think that the one area where this is most clear is, of course, in the area of immigration policy. In his State of the Union address, President Obama touched on the immigration, stating that his policy was to continue to make border security the responsibility and priority of the federal government, to hold accountable businesses that break the law by exploiting undocumented workers, to make those living in the United States illegally take responsibility for their actions, and to strengthen our economic competitiveness by creating a legal immigration system that meets our diverse needs. I think the first 3 points are relatively straightforward, though not necessarily beyond debate, as I'm sure will become clear in the Congress, in the next Congress, particularly around the DREAM Act, which is likely to be reintroduced. But I want to focus on the fourth point, diverse needs, strengthening our economic competitiveness by creating a legal immigration system that meets our diverse needs. What do we mean by diverse needs? On the one hand, I think it means making sure that the U.S. is able to continue to recruit and integrate the workers it needs in key economic fields. But on the other, I think it also means supporting developed economies and strengthening emerging ones so that they can continue to be or become not just trading partners for the U.S., but also partners in the defense of democracy around the world. In other words, it means looking after our own needs at home, but also sharing our wealth, not just our material wealth, although there may be some debate about how much material wealth we have these days, but our wealth of knowledge, scientific, technological, financial, organizational. Sharing that wealth with other countries to help make globalization a rising tide that truly lifts all boats. So where does immigration fit into all of this? A legal immigration system is one that allows for the orderly flow of migrants into the country, but it also should be one, I think, that allows for the circulation of certain persons out of the country in response to both national and individual needs at both ends of the immigration chain, so that people can come into the country for education and training and to work in certain industries where and when there is demand here. But then they can also move out of this country to go back to their own countries to bring skills and education, human capital, as well as labor power to emerging economies where they are sorely needed. And then perhaps those same people would come back to the United States to work here again for further training, further education, and go back again. In other words, to keep doing this across a period of time. In other words, I'm talking about reconceiving migration. Notice I'm not talking about immigration, but to think about migration not just as a one-way street, but as a circular, ongoing, perhaps lifelong process for individuals and families as they strive to maximize their potential and their opportunities in a global economy. Let me bring this back home with a concrete example. Many Americans, many of you in Congress, many of you who work in Congress, now commute for jobs. I come from academia where this is very common. My husband and I commuted for 14 years before we were able to both land jobs in the same place, and so I know exactly what this means. And of course we were able to do this because when you're an American citizen and you're migrating, commuting, which is really migrating within the country, you can do this without impediment. And I think that it might be constructive and productive to think about ways to give foreign-born workers the same kind of opportunities. Let's think about this in terms of a couple of different fields. In healthcare today in the U.S., fully 1/4 of professionals, doctors, nurses, technicians, and other kinds of healthcare providers are now foreign-born. And they provide essential services to our healthcare system while they're here. But they also learn and they come to possess skills and knowledge that are crucial to the well-being and the health care of the populations in their home countries. Why not make it possible for these people to contribute in both places, to be educated here, to be trained here, and then to bring those skills back to their home countries, and then maybe come back again for retraining. Similarly, migrant workers in non-professional service fields, child care, elder care, and other domestic services make it possible for more skilled and professional American workers, especially women, to pursue their careers and contribute to America's economic progress. But at the same time, these migrant workers who are providing such essential care services here are depriving their own families and their communities in their home countries of their human capital. In other words, for a long time we've been talking about a brain drain, but we also need to be thinking about a care drain that's affecting many of the sending countries that we're dealing with. Now, to be sure, these migrants are sending back remittances which are crucial to the economies and to their own families and communities. But at the same time, they're creating certain disruptions in those families and communities, disruptions that may actually be undermining long-term development goals of the United States in terms of education, nutrition, health gains, and so forth, that are being supported by U.S. foreign aid dollars. So at the same time as we're trying to support development in some of these emerging economies, we're also, I think, undermining it to some extent by disrupting families, by drawing key workers who are key family members into our economy here. So again, why not allow these people to circulate? Why not allow them to come here, earn much needed money that they often use to pay school fees or for health care for their family members, and then go back home so they don't disrupt their families for long-term periods. There are programs now in Canada and in certain parts of Europe that are working fairly successfully that we should be really looking at as models for this kind of thing. Now, temporary visa programs, what we would need for this, of course, would be temporary visa programs that allow for this kind of work to be done. And these visas might or might not be connected to long-term permanent residency and so forth. This is something that would obviously have to be debated. But I think we shouldn't deny the fact that these migrants are not just the high-skilled migrants, not just the people in the technological fields, the scientific fields that we think of so often, but it's these people who are considered to be low-skilled migrants, and I don't know that I would necessarily agree that they're low-skilled. They have skills that are not necessarily recognized as professional, but they're obviously very important, that these migrants are meeting current economic and social needs in the United States, and at the same time these migrants have responsibilities abroad that I think we should be taking into consideration as we think about our immigration policy. So a more flexible immigration system would be better able to meet these diverse needs of our economy. What does this mean for Congress? There's already some discussion about blue cards for agricultural workers. Perhaps these could be considered for care workers as well. The Migration Policy Institute in a recent report discovered that these low-skilled migrants are not necessarily competing with Americans for jobs. They're competing for different, they're taking different jobs that Americans don't necessarily want. And at the same time, they're contributing to our economy through the ripples of demand and consumption, consumerism that is affecting our economy here. So perhaps that's one way to think about it. Visas for high-skilled workers are pretty well established at this point. It may be necessary to give some thought to exactly the areas in which they're being offered, and there has been some talk of establishing an immigration commission that would be able to develop immigration policies in a more flexible way, and so that's something that is possibly going to come up in this Congress as well. But I think what we really need to be thinking about and looking at is a double-sided migration policy that responds to demands for workers and for human capital all around the globe. Thank you.
Thank you very much, Sonia. Ambassador Stapleton Roy is our third speaker. Stape retired from the Foreign Service 10 years ago. He had served as our ambassador to China. He is director of the Kissinger Institute on China in the United States. Stape.
Thanks, Mike. Good morning. Let's turn this on. There we go. We're broadly looking at foreign policy challenges facing the new Congress, and particularly the global economic issues, of which, of course, China is a prominent one. Attention in Washington last week was focused on the visit by President Hu Jintao of China, and this is the way it should be. China needs attention from the United States. Growing numbers of Americans are aware of the fact that China poses a fundamental challenge to the United States. There's ample evidence that the leaders in Beijing have the economic base to move from being a regional power to being a global power. China's rapid recovery from the financial crisis has accelerated this trend, and Beijing's assertive behavior over the last year and a half has demonstrated the awareness of Chinese at all levels, from the leaders on down to the person in the street, that they're aware of China's new global stature, and it's being reflected in their behavior. There's no guarantee, of course, that past performance is an indicator of what lies ahead. But I just a few days ago attended a conference among Chinese, Japanese, and Americans, and the assumption on the part of all participants, Chinese, Japanese, and Americans, is that China is likely to continue its pattern of rapid growth over the period ahead. But the economy could easily go off the rails at some point, and the rapid rate of growth is generating social tensions in China that are exacerbating the problem of maintaining social stability. So we need to not only look at the upside, we have to be conscious of the potential downside. For the moment, therefore, the economic rise of China requires informed attention, not panicky reactions. But the economic challenge facing our country is far broader than that of China alone. India's economy is now growing at near double-digit levels, and moreover, at current growth rates, its population is going to exceed that of China within a few short decades. The hard reality, therefore, is that we, the United States, and the rest of the developed world are faced with not one, but two economic powerhouses that are growing like gangbusters, and it will confront our economy and our foreign policy with a new set of challenges. The challenge we face from China is also far broader than the trade and currency issues that we tend to give so much attention to. Let me cite a few facts. The world's largest airport is now in China. China has replaced the United States as the world's #1 high-technology exporter. In a survey of global firms planning to build new R&D facilities, 77% said that they will build in China or India. In less than 15 years, China has moved from 14th place to 2nd place in published research articles. We're still the leader, but China has moved very rapidly up the ladder. China's Tsinghua and Peking universities are the 2 largest suppliers of students who receive PhDs from American universities. China has 5,612 miles of high-speed rail under construction and a plant that produces 200 trains each year capable of operating at 217 miles per hour. The United States does not have any trains capable of operating at that, and we have no high-speed rail under construction. In 2007, China became second only to the United States in the estimated number of people engaged in scientific and engineering research and development, and in May 2010, just last year, a supercomputer produced in China was ranked the world's 2nd fastest. None of these achievements is directly related to imbalances in our trade relations. So in other words, China is rising in ways that aren't caused by currency factors or by trade problems. It's rising across the board, and this is part of the challenge that we're facing. A recent IMF study looked at how China's growth is affecting the rest of the world. It used to have a regional impact, but the study concluded that China's growth now is affecting growth in other parts of the world by as much as 0.4%, which is a very significant feature. So in other words, China is now challenging the U.S. position historically as the engine of global growth. At the same time, and I keep coming back to this factor, we have to bear in mind the fragility of a process of rapid economic change. Chinese Premier Wen Jiabao, who is the primary official in China responsible for the performance of the Chinese economy, repeatedly states that China's economy is unbalanced, uncoordinated, and unsustainable. If anybody knows, Premier Wen Jiabao should know. Many visitors to China comment on the contrast between the country's self-confident external behavior and the domestic fixation verging on paranoia about domestic stability. Can the United States rise to this challenge? The answer, in my view, is clearly yes, provided we get our domestic house in order and restore the health and the credibility of our economy. One of our problems in the world right now is that China is seen as succeeding and we are seen as declining. I think that's an inaccurate portrayal of what the underlying facts are, but we have to deal with perceptions as well as the realities. Our exports to China have been growing faster, much faster, than to any major other export market. Our coordination mechanisms with China for dealing with the trade and financial issues that we do frequently encounter with them are the best that they have ever been. We saw this clearly in the visit by President Hu Jintao. I've seen lots of presidential summits, and this, in my experience, was one of the best prepared summits, and it was reflected in the results. Lucrative business deals were concluded, valued at over $40 billion, including a major sale of 200 Boeing aircraft, progress in key areas such as government procurement policies in China, which have been discriminating against foreign firms, American firms, and on issues such as protection of intellectual property rights. In all of these areas, significant steps forward were taken. These accomplishments illustrate the benefits we can derive from trade, provided that we maintain our competitive position in the world. This is where our focus should be. The emergence of China as an economic powerhouse with India in close pursuit is posing profound questions for the developed countries of the world, of which we are the primary example. If India is to services what China is to manufacturing, what role is that going to leave for the developed countries in the global economy? And down the road, India is now focusing on trying to increase its manufacturing sector, and China is focusing on trying to increase its services sector, which was simply going to make this challenge even more difficult. This highlights the importance of the study made by the National Academies of Sciences and Engineering 5 years ago, updated last year, which concluded, without a renewed effort to bolster the foundations of our competitiveness, we can expect to lose our privileged position. The conclusion of the updated report issued last year is that over the 5 years since the original report, our competitive position has declined. In other words, we are not focusing on getting our domestic act together so that we can deal with the competition that we are facing from China, India, Brazil, and a host of other countries in the global economy. This is the real challenge we face from China. Thank you.
Thank you very much, State. Our fourth speaker is Dr. Blair Ruble, served for over 20 years as the director of the Kennan Institute at the Woodrow Wilson Center. He also is director of the Comparative Urban Studies program, and Blair is going to talk to the urban challenges. Blair.
Thank you very much, Mike, and thank you all for coming out today. We live in a world that is different from the world that any of our ancestors lived in. Now, that's not a particularly profound statement. Every generation lives in a slightly different world. But I think the themes of this panel are really talking about significant breakpoints. The impact of globalization, of technology, of new immigration patterns, the rise of China. And there's another very profound way in which our world is different from the world before 2008. And it's one we don't pay a lot of attention to, and I'm going to talk a little bit about today. In 2008, for the first time in history, more human beings lived in cities than in rural areas. Now, that's a UN calculation. The number 3.3 billion can be argued around the edges, but what's important here is the trend line. About half of all of us live in cities today. 100 years ago, that was 13%. 200 years ago, it was 3%. That is a profound change that we need to begin to consider when we think about and talk about all the policies we've just been discussing here. Moreover, the number of city folk will continue to grow at an accelerating rate for at least the next half century. Then migration from the countryside will ease down because there'll be fewer people simply to migrate. And one already sees that pattern in Latin America, which is the most urbanized continent on Earth. There are 324 million people living in 21 megacities with over 10 million residents. Delhi, Dhaka, Jakarta, Mexico City, the list can go on and on. But I want to suggest that they aren't the real challenge. The real challenge are the people who live in the 500 cities with more than 1 million residents and the 950 urban centers with more than 500,000 residents. These are the cities where most of the growth is taking place. These are the cities which get the least attention when we think about policy. And finally, with the exception of Africa, the rural population on every continent is in decline. So what we see is that in a little more than a century, we have gone from being a rural animal to being an urban animal. And that profound change affects everything we do. And we need to begin to factor that in when we look at specific policies. Now, I want to run through 8 new realities that are connected with this urban challenge, just to get them on the table, and we can discuss details later if you like. First, global population growth will continue to concentrate in urban areas in the developing world, which will become home to more than 2 billion new residents over the next 2 decades. Every year for the next 20 years, 100 million people, the equivalent of Mexico, will move from rural areas to urban areas around the world. And most of this movement will take place in Africa and in Asia. Because in the Americas and in Europe, it's already taken place. Second, such growth is proportionately less a consequence of migration and more a consequence of natural population growth in cities. So even if we can come up with policies which no one has able to come up with to keep people on the farm, this urban revolution isn't going to stop. Third, cities are not only growing, but they're producing increasing amounts of the world's wealth. And yet simultaneously, and this is the fourth point, global poverty is increasing most rapidly in urban areas. So there's this contradiction which is reflected in a profound increase in income inequality, particularly in Africa and Asia. And the absolute number of poor people living in cities is now higher than the absolute number living in rural areas. Now, where do poor people live in many cities around the world? They live in informal settlements, which we sometimes call slums. If you think about what you saw in Slumdog Millionaire, that is the kind of environment in the self-built community in which hundreds of thousands of people live. 72% of the urban population of Africa lives in self-built communities. So there's a nexus here between urban poverty and these informal communities. And what one sees is even as people move beyond poverty levels, they still live in these informal communities. Finally, there's a geographic, not finally, but in addition, there's a geographic change which is taking place. Around the world, urban density is declining. 25, 30 years ago, one talked about American suburbia and the fact that most of us are coming to live in so-called suburbs as somehow an anomaly. But in fact, all cities everywhere are decentralizing. Population density has fallen by a third over the past 20 years, according to analysis of satellite photographs. So what's really happening isn't suburbanization. What's happening is what the city is changing. And we need to wrap our minds around this change in new ways, or we can't grasp what's going on. Here we have the debate about so-called metropolitan areas, but the reality is that urban areas are large, moderately settled, not densely settled, carpets of population that extend for hundreds of miles in each direction. LA has become, in a certain sense, the model for what the new city is. And then the real challenge is at different technological levels, that morphology plays itself out in different ways. But what that means is, again, we have to think differently than we've ever thought before about how we confront these realities and how we deal with these realities and how we build them into our thinking about policy. Rising sea levels, this is perhaps a little controversial, but just keep in mind that 2/5 of the world 1 million plus cities are located on coastlines. So if indeed there are rising sea levels, that's going to, we think we have a migration set of issues now. Wait until all those cities have to face rising coastlines, and we'll have more challenges. And finally, you've already heard from my colleague Sonia about migration, but this is all impacted by the fact that this is one of the highest periods of migration in human history. So when you add this together, what it means is that the urban age is just beginning. It isn't coming to an end. And we tend not to realize that because we have a different discussion here about what it means, what the city means, what urban means. But we need to begin to factor this in as we think about certainly our engagement with the world outside. When we think about national security, where terrorist threats are going to come from, they're going to be largely urban because that's where people live. When we think about health, when we think about the environment. And there's another way in which I think the fact that the traditional city has taken steroids and has blown up into the urban region begins to focus our attention on a policy agenda. When you talk about informal communities, the response is always local, as well as it should be. But how local is a phenomena that's taking place everywhere? And we need to begin to understand that some challenges we think of local, if it's repeating itself everywhere, has to be thought of globally. So while it's true that dysfunctional urban communities can only be improved by a house-by-house, business-by-business, block-by-block, neighborhood-by-neighborhood approach, we somehow have to figure out, and this is something that is perhaps the most difficult part of policy changes, how to aggregate those micro-level responses so that they add up to a macro-level response. And then we can begin to factor these developments into our thinking about a whole range of policy issues which you'll be facing. Thank you.
Thank you very much, Blair. The last speaker will be Dr. Sam Wells, a senior scholar at the Woodrow Wilson Center, currently writing a book on the origins of the Korean War. Sam has served the center with distinction for over 3 decades. Sam, thank you. He's going to talk about the Eurozone, I believe. Sam.
Thanks, Mike. Well, good morning, and thank you all for coming out. Europe doesn't get a great deal of attention these days, except when there's some terrorist incident or a great deal of economic distress, a country about to go into debt crisis that would require it to renounce all its debts. Many in the U.S., and I think many editors of our papers and television news, consider Europe an old story, and it is that, but it's also a vital new story, and Europe is the essential partner that policy specialists count on to help us deal with the kind of challenges that Blair just referred to with regard to urban issues, that Ambassador Roy referred to with regard to China and India. Europe right now is not in a good place because of its current economic crisis. There's some reasons that are fairly clear for that, although the debate in the United States, if there is much debate, is focusing on European unwillingness to make tough decisions. The debate in Europe is focusing on Germany's unwillingness to be a team player and help the weaker members of the Eurozone. So here's an overview of why this is important, how it came about, with not a great deal of attention to the 2 major incidents that have gotten most of the ink, which are the Greek financial collapse and the Irish financial crisis, which led to a big bailout. Okay, what caused the European crisis and what proportion of it is attributable to the United States? This was, for a long time, the European argument. This is a U.S.-created crisis. It won't affect us. It is true that the crisis began with the U.S. housing bubble. But as you start to think about the economy, remember it's global. Remember that there are every day trillions of dollars moving through billions of trading relationships that are entirely global. These relationships are especially dense between Europe and the United States. The U.S. housing bubble, starting in 2007, created a banking crisis here. European banks were major buyers of derivatives composed of securitized U.S. mortgages, including a significant proportion of subprime mortgages. As I said, European officials were slow to recognize that their banks and investors had a problem. They delayed in responding because it looked like they would have to be aiding private banks that had taken significant risk. They didn't want to start down that road. They eventually had to. The U.S. Federal Reserve helped them in dealing with their bailouts. There are some distinctively European causes which are now admitted by Europeans and acknowledged by Americans. Housing bubbles comparable to our own developed in Ireland and Spain, and to a lesser degree in Portugal. The Greek case has different origins. They didn't have as much of a housing bubble as they had profligate spending and phony accounting, which meant that their debts were immense, and they were sailing along piling up more debts on cheap credit, which I will explain in a minute. Further complicating the problem is that the economies of much of southern Europe, Greece, Portugal, and Italy in particular, are non-competitive in terms of economic productivity. There are structural imbalances in the 16-member zone that uses the single currency of the euro. There are countries in northern Europe, typified by Germany, that have high growth, large exports, and low consumption because they have a high savings rate, whereas in the South, the economic profile is dominated by budget deficits, low competitiveness, and low productivity. The problem came that in the Eurozone, which has a common currency administered by the European Central Bank, people who lent money assumed that the Eurozone would all be treated as one economic area, which the advocates of the Euro certainly encouraged. But the fact was that there were these structural imbalances. The functioning of the economies in Northern Europe were much better than those in the South. The South could still borrow if you were a Greek company or a Greek small business or you were a homeowner. You could borrow at the same kind of rates as if you were operating in Germany, but you weren't in a German-style economy. So this led to a lot of irresponsible borrowing or lending to countries in the south of Europe. Finally, in the European causes, there was an imperfect design built into the Eurozone itself. Economists understand that when you have a single currency, you have a currency zone managed by a single central bank, you need a coordinated or perhaps even a unified fiscal, tax, and spending policy. The wise people who did the studies and set up the Eurozone in the mid-1990s understood that. They proposed both, but politically they could not sell to the individual members who were proud of their own tax structures and budgetary processes. They could not sell a unified or even coordinated fiscal policy. So the Eurozone has a single currency rate that generates interest rates of comparable proportion throughout the 16 members, but their taxing and budgetary processes are very different, and the countries run very different kinds of deficits. These were some of the major causes, certainly of the Greek crisis, where they borrowed much too much. They led to a bailout of the Greek government and the creation of a temporary financial stability facility in May of last year, 2010. At the same time that there was developing a banking crisis in Ireland. We can talk about either one of these if you want later on. The Irish problem was somewhat different. It began with the housing bubble, but then there were a lot of banking complications. Banks had made huge loans that were not supported by adequate collateral or even adequate projects. They had involved politicians in supporting these loans, so there was a political and banking dimension, which led to then a bailout in November of last year of Ireland, and the creation or the commitment by the European members of the Eurozone last December to create a permanent liquidity facility, that is, a large pool of money funded by each of the member states, the largest amount coming from Germany, that would help countries where the government was in a debt crisis and could not repay its loans. Comparable to our Dodd-Frank financial regulatory bill, the Europeans also set up at their summit last December 4 new regulatory bodies, comparable to some of the strengthening regulatory mechanisms we have here. Note that they were slow to get these in place, and they will be fairly thin on the ground in terms both of financial capacity and staff. There is a systemic risk board, which will do the same thing that our Economic National Council will do. There is a banking authority which coordinates things like this Basel set of criteria that Kent Hughes talked about in the first presentation. There is a Securities and Market Authority that is separate to be supervising market and securitization. And then there is a separate regulatory organization for insurance and pensions. All of these will come from groups of national regulators. They will probably have, when they're fully staffed, about 100 staff members apiece, which is frankly not very many. Now, there are in these various trends in Europe, there are some significant trends that I'll just draw your attention to. Germany has the largest and most dynamic economy in Europe. And as a result, when countries have to pay in, the Germans are called on to pay the largest amount. If they refuse, they in fact exercise a veto. The Chancellor, Angela Merkel, has been very reluctant to commit Germany to any of these processes. She's delayed making a decision. As some of the crises have deepened, the cost then of the bailout was all the more. The size and nature of the powers of these regulatory bodies are weaker than many people think they should be, largely because of Germany. Now, she has problems. Her country has its financial house in order. They're growing. They're leading the Eurozone in productivity and balanced budgets. She has a population that has already cut back on their deficit. They've expanded their retirement age. They don't want to go through further sacrifice to bail out the Greeks who retire 10 years earlier and have quite lavish pensions. There are other factors that add into it, including the fact that the banks have been allowed to consistently obscure the amount of debt that they hold and the type of debt, and the bondholders and traders have pressed the argument quite effectively that any losses to debt holders would undermine the credibility of the entire Eurozone, so that the bailouts that occurred in Greece and in Ireland, in fact, put the burden of the payment on the populace of those countries, whereas the bondholders and the risk takers in the banks got reimbursed 100%. Now, that's something that there's a growing animosity about in Europe. There would be probably people in the streets here. It's amazing that they aren't there. They may get there yet. Now, the implications for the Congress are a little more distant than some of the things that have been talked about, but people need to realize that a Europe in stagnation or an economic crisis has a significant economic impact on U.S. trade and earnings from our very large direct investment there. All economies engaged with Europe, and the U.S. being the most engaged, will have the greater complications. It does mean, in addition, that while we need to pay attention to and at least not complicate Europe's dealing with its own financial problems, we also cannot expect help from the Europeans in major ventures like Iraq or Afghanistan, or in major disasters such as have occurred in Pakistan and Indonesia in recent years. The Europeans will be in a period of low growth and constant dealing with their internal economic problems for a long time, and we need to do what we can to help them get back to the economic position where they can be a reliable partner in dealing with some very serious crises that are coming down the road. Thank you.
Thanks, Sam. That tees it up. We have a little over 35 minutes for questions from you all, and please raise your hand, identify, and I believe the microphone will be sent around. Who would like to ask the first question? Don't be shy. Yeah. The microphone's coming.
Thank you. Good afternoon, ladies and gentlemen. Thank you so much for a very well thought out and thorough analysis of some of the concerns and crises that we face going forward. And I guess this is just a general my name is Bradley Toney. I'm an intern for Colorado Senator Mark Udall, and I'm here on behalf of legislative correspondent Jennifer Barrett. My question to you all as a group is I'm curious about things with cyber terrorism, and I'd like to know how issues of cyber terrorism would affect the economic markets going forward in here in America and Europe, and it's of course a broad question that I pose to all of you guys.
Who would like to take a handle on that first? Kent or Sam?
We've been worrying about cyber terrorism for some time, but it certainly has moved much more center stage than it did in the past. The risk, of course, is highlighted by the fact that, as a military person would say, there's just an enormous volume of material that's exfiltrated from the Department of Defense. By and large, so far at least, as far as we know, it's not classified material that's being reached yet. But think of the potential disruption of the banking system, of the eastern grid, and so forth. So people are moving on two tracks here. Number one is a technology track that is attempting to eliminate the ability and make the whole system more robust. And second, of course, there is the classic, maybe almost the James Bond approach that is trying to infiltrate and identify groups that are attempting to do this. It was interesting in the response to the WikiLeaks case that there were volunteer hackers, apparently a hacker nation kind of group that decided if you weren't going to be nice to WikiLeaks, well, we're going to make you pay. So this is an enormous problem, and we are, as you know, almost everybody that comes in, if you can't get into your email and so forth, why it's a crisis of the day. Business services are traded increasingly across borders. When SARS, a flu pandemic, erupted in China, it was the buying season. People did it via video conference instead. That could be easily disrupted. So it's a very serious problem that people are taking very seriously.
Anybody else want to comment on that? Yeah, over here, and then back there.
Peter Wogert, German Institute of Global and Regional Studies. I have a very general kind of statement which I would like to have several speakers perhaps just speak about it. And that is the imbalances we talked about, US-China and within Europe. One of the issues clearly is discipline. That is that the Chinese and the Germans are over-saving and not spending enough, but going into exports. The US and Southern Europe is the opposite. The question is, are there fiscal policies, incentives, which could change or bring in a discipline in the deficit countries, which would correct? Or are we unable to do it because at this point in time, with a lax monetary policy and no threat of inflation, there is not the real pressure which would bring in this new kind of balance we are looking forward?
Well, that's another very good question. And Chancellor Merkel, as an example, has identified Germany as a natural export surplus country, which has not been welcomed by other members of the Eurozone. What can we do about these imbalances? Big surpluses in China, somewhat big surpluses in Japan, other parts of Asia, and again, Germany being a major export surplus country. If the U.S. went on a dramatic reduction of fiscal saving, which would be a way of reducing our deficit, and if there was a sudden move here to saving more, we've already gone from almost 0 to 5 or 6% in terms of personal savings. If we did more of that, it simply would mean that global demand would decrease. If all the deficit countries stopped at once, global demand would decrease. It would be bad for us, but it would be bad for the exporting countries as well. It would be, ideally, I think, more effective if we could have something like a Plaza II Accord. That 1985, there was a similar kind of situation, smaller in quantitative impact. The surplus and deficit countries met and agreed that there had to be those kind of internal adjustments. In effect, in that case, Germany and Japan depending more on domestic growth and less on exports, and the U.S. doing the opposite. In this case, clearly, China and others would have to be at that table. The advantage of that approach is that it allows for a gradual adjustment on both sides. But it would be part of what we would be doing. Stape alluded to it, the report of Rising Above the Gathering Storm, which implies putting our fiscal house in order as well as making the critical investments in education and research and so forth. So if that doesn't happen, I think the U.S. may have to consider alternative approaches that would not be as smooth.
Stape or Sam, do you want to add to that?
I'll just add briefly. I referred to this national report on productivity. To me, productivity is the key, because if you increase productivity, you can have a positive economic growth and a positive savings rate. If your productivity is low, you have a problem. We have not addressed this issue of domestic savings. We let our economy become dependent for its growth rate on negative savings, or essentially on consumption. China now has active policies designed to increase consumption in China, but our increase in domestic savings resulted from the financial crisis, not from government policies. And we are deferring until we get recovery.
There's a briefcase out here, excuse me, there's a briefcase out here in the hallway. There's somebody's briefcase. I apologize for
Yes, it's ours. Sorry, it's ours.
You need to come out and get it, please.
Great.
Yeah. Just to conclude the point, we can't just keep putting off the question of addressing it, but there is exactly the parallel that Kent has referred to. If you increase savings, it's at the expense of consumption, and that has a global impact, and it also has a domestic impact in terms of economic performance, but productivity increases can help you solve that problem.
Sam, do you want to add?
Yeah, there's one other point that might stir up a real debate, certainly in this location. One of the problems that Peter mentioned is this question of discipline, and it's very hard to discipline the American consumer. One way of starting to do that could be a value-added tax, which is anathema to many of the current majority in the House of Representatives. But I just put that on the table. That's one of the things that could be done that would have an effect, so that the people who do the consuming can't necessarily take advantage of tax loopholes or other ways to avoid paying their share of basic expenses.
The next question is the gentleman right next to the camera. Yep.
Hello. Good morning. My name is John Young. I'm from the Committee on Ways and Means, and my question is, as I think Mr. Stapleton or Mr. Roy said earlier, the currency imbalance between China and the U.S. is not the main reason for the current financial issues that we're experiencing now, but it is true that trade is a factor that is making us unable to invest the kind of money that we want to in things that would help us get out of this crisis. I guess, to what extent is our economic viability dependent on trade imbalances with China, and what is the likelihood, based on, I guess, China's recently suggesting that we move to the renminbi being the world currency, and the IMF recently telling us that we need to curb our spending. What's the likelihood of us reaching some sort of agreement with them to get their currency pegged to what it could be, and how would that help us?
Go ahead. Both Ken.
You want to start, Ken?
Sure. I think the trade imbalance is a serious question for us. We've been borrowing, prior to the financial crisis, 5 or 6% of GDP. Nothing wrong with borrowing. A lot of us borrowed to put ourselves through college. A lot of us borrowed to invest in other aspects of our lives. But the question is, of course, what do you do with the borrowing? And we actually have used our borrowing to have really an unsustainable level of consumption rather than investment. The second is that our borrowing has not just been borrowing in the abstract. It's had, in my view, a negative impact on the manufacturing sector. And by and large, the way you pay your way in the world is through exports of goods and services, but goods dominate. That means manufacturing, in our case, to some extent, agriculture. The other piece, it's very important in the longer term to think about, is what Stape alluded to in terms of productivity. And that drives a whole innovation agenda. And if you come up with a great idea, but you no longer have the industrial base to translate that idea into production and jobs and growth and so forth, you will not have the kind of productive economy that you really want if you want to continue to pursue the American dream and have the United States as a leader. So I think, as Stape says, we have challenges in education. It has nothing to do with the trade deficit. We are not focused on an overall manufacturing strategy. That's our problem. The lack of financial regulation or regulators that didn't do their job. Can't blame that on the trade deficit either, but the trade deficit is a real challenge for us.
Briefly, the Chinese are interested in having the renminbi become an international currency. That's a good thing. At the moment, China is one of the world's biggest trading countries, but it's the only trading country that doesn't have a convertible currency. They have capital controls, and they manage the exchange rate. So if it wants to become an international currency, it has to move in the direction of convertibility. That's a direction that China should move in. It's behind the timetable in terms of getting there. I think it's a very positive move. That will not solve our problems, but it will mean that China has taken steps that we consider desirable. But some of the other ways that China could contribute to our economic difficulties is by investment in the United States. Now, this is an issue that's going to come before Congress, and in many cases it will be presented in a negative way. This is what happened when Japan began to invest in the United States and began to move their manufacturing facilities to the United States in order to address issues of domestic content. China could pursue the same progress. In other words, when Japan first began to do it, everybody was resistant to Japanese investment in the United States, and then all of a sudden we discovered it was creating jobs. I was buying foreign cars that were made in Ohio, and I was buying American cars that were made in Canada. These are the sorts of changes that can take place. So I think the potential for billions of dollars of investment from China coming in and an appreciating currency will give China that much more investment power in the United States. There are going to be a lot of issues raised by this, and Congress is going to focus on many of them, including, where is it safe to let foreign people own our domestic assets. But the United States is a major investment in countries abroad, and it's not, in my experience, that we use our foreign investment in order to destabilize countries or to do anything except earn money.
Yeah.
I think the issue, one issue that will certainly come up is with high technology acquisitions. And right now there is a committee on foreign investment in the U.S. that looks at national security implications. You probably working on in the Congress will see legislation that will attempt to broaden that review to include what are viewed by the introducers of the legislation as critical technologies.
Yes.
What's the possibility, instead of complaining about China's currency being low, actually trying to lower our our currency so that we're more competitive with China and India, because that may be the wave of the future?
That's the root of the problem. Our currency has depreciated. I just came back from Japan, and I'll tell you, you really notice it when you go to a country where the currency is appreciated against you. The dollar buys a lot less. The problem is that China has been pegged to the dollar, so that when our currency depreciates, so does China's, vis-a-vis the dollar. And other countries. This is why we're not the only country that objects to China's currency practices, because all of the other exporting countries don't like it when China's currency depreciates along with the dollar, and that effectively means that their currencies are appreciating. So I think that these pressures from many countries, plus the fact that China discovered in 2008 that its own domestic economy was highly vulnerable to external factors such as the financial crisis in the United States that caused their exports to plummet. So China has realized that being overly dependent on the export sector to fuel their economic growth is a dangerous strategy, and that they need to have domestic consumption and investment play a greater role in their strategy. They are actually taking measures to deal with this. This is why I constantly harp on the fact we're talking about increasing our domestic savings rate, but there's not a single policy in place designed to do that. We're pointing to the results of unless you say that the financial crisis was the policy designed to increase our domestic savings rate, which I think is the wrong approach.
I don't think that was the policy. We actually had a fellow at the Wilson Center who looked at the institutional nature of Japan and Germany, which have much higher savings rates, compared to the institutions here. And whatever consumers wanted or didn't want, there really was a whole set of institutions that facilitated saving in Germany and Japan. And I think in addition to Sam's thought about moving to where you have a value-added tax, so in a sense you discourage consumption as opposed to investment, we might also look at some of these institutional factors, which could be a government policy that would encourage saving.
Yes.
Hi, my name is Sharon Madden.
And then
China Commission, and I have a question that is not related to China at all, other than that they have a VAT, and it's concerning the VAT. So this may be a bit beyond the scope of your remarks, but VAT has come up in a number of occasions as a way to deal with consumption in the United States. How would a VAT work in the United States where each state seems to have its own sales tax? Would they be consolidated, or how would it be allocated?
Well, the most effective way would certainly be to have a national VAT and then to adjust the national income tax in relation to that, so that you derive a certain proportion, so that you try and keep the overall tax burden for an average consumer, whatever that animal looks like, the same, but you get part of it via VAT, and you get part through your federal income tax.
Under President Nixon, there was something called revenue sharing, where because the U.S. was an efficient tax collector, then some of that money would flow back to the states. So you could, in theory, have an overall VAT tax, a portion of which would go to the state in lieu of whatever sales tax they might have been pursuing, or they could continue to have a sales tax on top of whatever the VAT happened to be.
yes, lady here.
Hi, I work for the Senate Banking Committee, and I work primarily on transportation issues, and I was wondering, in terms of productivity, are you arguing for improvement of infrastructure the way the Obama administration has been discussing, or in other ways as well?
I'll begin, but others can comment on that. Certainly, improvements in our infrastructure is a way of improving our productivity. You see this particularly in underdeveloped economies, where putting a paved road in that enables the farmers to get their produce to market that much faster and quicker has a remarkable impact on the productivity of the rural sector. So the infrastructure really does matter. Secondly, I travel internationally a lot. It's embarrassing to come back to the United States. The comparison of and it never was this way. I served in the U.S. government for nearly 50 years, and I used to be proud to come back to the United States because things work better here. Now we are falling behind. Other airports are more efficient. Other immigration procedures are more efficient. We seem resistant to looking at the experience of others in terms of how they're doing things. And I think that we ought to be pursuing what business has established as a principle, which is best practices should be. We should eagerly look at how other countries are handling similar problems and seeing whether we can learn from them instead of assuming that we automatically will do things our own way. That's my comment. But
Yeah.
Kent, you want
Blair or Kent, do you want to add to that?
Well, I think just think about what happened in the Washington metropolitan area this week and how much money was lost because of ineffective snow removal, infrastructure that is crumbling and not up to the task. I think about the water main break in PG County, and if you calculate the economic impact of that, my suspicion is it's a lot more than it would have taken to actually have systematically monitored pipes and changed them. We make our calculations on what costs us money with a short-term view, and the problem with infrastructure is it's a long-term investment. It was easy to raise money to build the metropolitan area metro system. It's harder to raise money to maintain it because there are fewer opportunities to go down and cut ribbons and pat yourself on the back. And this is and the implications of this begin to pop up in some of the issues I was talking about when you see the most creative urban management schemes coming out of Brazil and not out of here. We just aren't serious about this, and there are lots of issues about how you pay for it and what's appropriate, but we have to begin by understanding that lack of investment in infrastructure ultimately has a cost. And we just lived through it this week. This isn't abstract. If we all think about how much wealth was burned up and people sitting in cars that were going nowhere because of for 5 inches of snow. I mean, it's true I'm a Russianist, so I tend to smirk at 5 inches of snow, but it's just not serious.
I just would add, first an amen, but also that beyond transportation, I think you'll hear a lot of talk in the Congress about having a long-term competitiveness strategy, which is another way of talking about a long-term productivity growth strategy, which certainly includes infrastructure. It includes research and development. It includes education. It includes reviewing regulations that may be getting in the way of entrepreneurial activity. But to second what Stape said, again and again we seem reluctant to do what business does, which is to benchmark to the best. We had an enormous debate over health care here, very serious debate, but very little talk about how it was done in a range of other advanced industrial countries. The debate seemed to be in Canada, oh, they have to wait in line. England, that's socialist, we don't want to look at that. What about France or Switzerland or Japan? So I think that's true in education as well. There's a lot of work that's done by the OECD, the Organization of Economic Cooperation and Development, analyzing these international tests that suggest at least initiatives we might want to think about here. But we tend to ignore that. So you're right, you're doing the Lord's work there on transportation and productivity.
Yes.
Over
here.
Hi, I'm Kevin Davis with Congressman Westmoreland. This question is directed at Dr. Wells, but I would be curious to hear the rest of your opinions. In the next 20 years or so, beyond that even, do you anticipate seeing a change in the makeup of the Eurozone member states, given the ever more obvious disparity among the North and the South member states, or even in the extreme case, a dissolution of the Eurozone?
Well, that's a question that's asked a lot in Europe, and I think among economists around the world who are looking at this currency zone. First, let me say that I think the Eurozone will survive if it comes to some good decisions which are being rumored to occur at a meeting of European finance ministers in March. They may get out ahead of the speculators for once in this whole 3-year episode. If they can do that, they can contain the debt crises more or less where they're presently located. And even since this crisis has been going on, you've had Estonia join the Eurozone. So the 16-member zone that was in the crisis is now 17, and one of the smaller but more dynamic economies among the new members of the EU has joined the zone as well. There are others who have applications pending, and they may join. With regard to the question of a country leaving the Eurozone, that would be very difficult. You would immediately find its currency value plummeting, and it would still have a large collection of debt in euros that it had to pay off at a disadvantageous rate. So it would mean almost a decade or 15 years of national recession to work your way out of that. What if the Europeans don't deal with their problems in an effective and timely manner in these economic crises? What you could have is a temporary split into a two-track Eurozone. You put some lesser requirements and lesser benefits onto some of the poorer performers and give them a chance to renegotiate some debt. There could be a mechanism, for example, to have this liquidity facility. There's a temporary one in place now, which probably will get expanded and strengthened in March, one would hope, and a permanent one coming into effect in 2013. This facility could buy the bonds of the Greek government or the Irish government, and by having this facility buy the bonds and Europeanize them, the rate, the value of them will rise, the interest rate at which they refinance new debt would go down, and they would be able to work their way out of the process. Presently, as recently as yesterday, the junior partner in the German governing coalition announced itself very opposed to that idea. But they are the junior partner, and Mrs. Merkel could get them by the ear and bring them along if she wished. We'll see. I mean, it's one of these stay tuned, and not just for the next 3 or 4 months, but for several years.
Are there other questions? Yes.
Good morning. This has been a great panel. My name is Rebecca Taylor. I'm an IEEE Fellow serving in the Science Technology Advisor's Office in the State Department. My question relates to things like the current account deficit and our trade imbalances, and I'm wondering whether any of you all have an opinion on the role of our tax policy and whether we should consider things like rearranging the corporate tax structure and making the R&D tax credit permanent to convince some of our companies to do more of their work here.
Well, let me start with the last piece of the question about making the R&D tax credit permanent. I think that's long overdue. We've had the R&D tax credit since the very early 1980s, and yet it has been renewed and renewed and renewed. Research generally is not a year-to-year kind of decision. You're investing in a longer-term effort to innovate and to develop a new product, a new process, whatever. So I think that's certainly something that ought to be done, but I see that really as more on the state's emphasis as an element of contributing to long-term productivity growth than dealing with the current account deficit. The other elements with regard to changing corporate tax that are likely to be debated, one is, of course, the corporate tax rate itself. And it is, the nominal rate is now, with Japan having made some changes, is the highest in the world. The effective tax rate, what corporations actually pay, varies a lot depending on what credits and deductions they have. I, in general, sometimes think it's useful for us to think of the United States as if it, let's say, were the state of Oregon or the state of Texas, which competes to attract investment from around the world and from other states. That we need to think about having a climate that is effective in terms of attracting that investment. And although it may not be the most important element, the corporate tax rate is certainly an element that every foreign investor or every Oregon investor looking at Texas would think about. I would be worried, however, if we reduce the corporate tax rate by eliminating the current set of so-called loopholes, one of which would be the R&D tax credit. Another would be accelerated depreciation. I think to some extent the current exemptions from the statutory rate help make up for the penalty that manufacturing has suffered because of everything from our policies in general and currency questions around the world. Third, the other issue I think that's likely to face the Congress is, again, a question about whether we should shift to a territorial tax rather than a global tax, that most countries do tax corporate income based on the home country. So if you are, let's say, French and you have an investment in Thailand, by and large, you're only taxed on your by and large on your French income. So I think that will be another issue. And if that is not adopted, then again there will be a debate over should there be a tax holiday so that U.S. corporations can repatriate earnings that are currently parked overseas.
Any other questions? You've been extraordinarily attentive. We thank you for coming. The next session will be exactly a week from today at 10 o'clock on the 4th. And it will, I believe, delve into security and development issues. And your question, there will be a colleague of ours who will be there that is doing some work on the cybersecurity issue. Okay, so thank you all for coming, and have a good day and good weekend. Thank my colleagues for being very good and very punctual.